Good morning, ladies and gentlemen. Welcome to the Bob Unger Show. We have a real treat today. We have a man who I've been following since I was in my 20s and had quite a bit of notoriety back in those days. His name is David Stockman. At the time, I believe he was the youngest congressman in the history of the United States. Is that correct?
Well, actually, at the time I was elected in 1976, I had two colleagues who were the same age. We were all 29, and they went on to bigger and better things. One of them was Al Gore, and he became vice president. The other was Dan Quayle, and he became vice president. So I've always been chagrined that I never got to be vice president. But other than that, yes, I was elected at age 29.
Well, you've got a little bit too much. I call you a walking oxymoron, a politician with integrity.
Yeah, well, that is a rare commodity. I appreciate the compliment, but after 40 years in politics, one way or another, I agree with you completely. Integrity is not the first word that comes to mind when you think of Capitol Hill.
Yeah, well, David, also, you want to talk about having what the Jews call chutzpah. David had the integrity to vote against the bailout of Chrysler at a time when he was representing a district that had auto workers because it was in Michigan.
Right. Yeah, as a matter of fact, that was a profound lesson. I was a young guy then. It was the Chrysler bailout in 1979. I had been a strict free market guy. I had railed against all the boondoggles and bailouts of the Carter administration. So when the Chrysler bailout came up, and I was on the committee actually in Congress that dealt with it, I voted no. I had Lee Iacocca, who was the CEO of Chrysler at the time, a very flamboyant, dramatic, headline-seeking kind of guy, denounced me from one end of the state to the other for being the only member of the Michigan delegation that voted no on saving the state. Well, the interesting thing was in the 1980 election, the next election, I got the highest vote that I ever received, 75% of the vote, roughly, because most of the small businessmen in the district are just plain workers at regular companies, knew that if their employer got in trouble, nobody was going to bail them out because they weren't big enough. They weren't squeaky enough. They weren't a squeaky enough wheel. And so I think the lesson I learned is that you can't grease the squeaky wheels because people understand that it's unfair and it's inappropriate and it's against the rules of a genuine free market. And of course, I went on from there to join the Reagan administration, and we tried to get rid of a lot of those subsidies, and some we succeeded in.
Well, before I get into your book, The Great Money Bubble, the last thing I want to say in an introduction is that you have a fantastic newsletter, which I read, and it's something I educate myself with, and it's called David Stockman's Contra Corner. And the thing that I like about it, besides the great information, is I would recommend to all the parents out there, because I'm a great believer in home education, even if your kids are not yet educated enough on economics at the age of, let's say, 15, to understand all the concepts that David talks about. David's vocabulary is absolutely incredible. And I'm somebody who prides myself on language. And as a lawyer, it means a lot to me because words are supposed to mean something, although these days I'm not quite sure. But have your kids read his articles and read his book with a dictionary.
Yeah.
And learn a few new words every day. And by the time you get through his writings, you'll make him look like an ignoramus. That's how your kids will be. So that's the final thing I have to say about your writings, and let's get into the book.
Okay, well, thank you very much. Appreciate your words. But it is important to communicate effectively and carefully. And if you have something to say, try to articulate it in a manner that is going to most effectively and directly, convey the thought that people need to hear. And so that's what I try to do. And if you make your vocabulary a little richer, then it's not going to be so boring, and maybe people will pay attention to what you have to say.
Well, anyone who knows me will tell you I certainly don't genuflect, patronize anyone.
Yeah.
So if I tell you something, you can believe that I believe it. Otherwise, I wouldn't say it. And so it's true. So let's get into the book. It used to be that when you look to invest, you would think about profit and loss. You would look at balance sheets. You would look at earnings. Now all you do is listen to what some unelected guru at the Federal Reserve has to say, and nothing else matters. How did we get to this point?
Well, that is a great question. That's the heart of the book. And you're right. It used to be about the fundamentals. What was the outlook for sales, profits, margins? What kind of competition does the company have? What's happening to the technology? Is it rising? Is it falling? Is there an Amazon on the horizon that's going to replace the mom and pop bookstore? Unfortunately, none of those fundamental questions really matter that much anymore. The market is totally focused on two things, and they're interrelated. One is the price action. I don't know how often you hear that phrase on CNBC, but it must be, once every 10 minutes. Now, it sounds profound. You listen to Jim Cramer, the price action, as if there is some kind of, secret formula. The price action is simply what's going up. Okay. It doesn't take any genius to open up your computer, to the stock pages and see what's going up. And the theory is if it's going up, it must be good. You better buy it. Chase the rabbit. Now, the second part of it is what is causing the rabbits to run is the actions of the Fed. And so everything turns on, the slightest nuance, the slightest hint that the Fed may be thinking about not doing 75 basis points next quarter, but 50 basis points or whatever the case may be at the moment. But, that is not a real capitalist system. That is not a financial market where price signals are giving honest, constructive readings. That's just a market chasing the actions of the Fed, and that's exactly what we have today, and we've had for a long time. Now, the key point that I would like to make, that I make in the book, but I think it's important for people to understand, the Fed has allegedly been tightening for 35 weeks. They started in March, way, way late, behind the curve. We know all of that. But they actually have been easing for 35 years, ever since Greenspan took over as chairman of the Fed in August 1987. And I think what's important is not the 400 basis points of increase since March, but the massive expansion of the Fed's balance sheet since 1987. And the numbers are just staggering. If you look at the balance sheet, when Greenspan took over and decided he was going to become the toast of the town in Washington, rather than the hard money man that Ronald Reagan thought he was, the balance sheet of the Fed was $200 billion. And it had taken 74 years from when the Fed opened its doors for business in 1914 to get to that $200 billion. Today, the balance sheet of the Fed, or it peaked a few months ago, was $9 trillion. So what we've had in a 35-year period is a 45-fold increase in the balance sheet of the Fed, which sounds arcane, but that's just the money supply. That's just the liquidity, the fiat credit that's been pumped into the system. Now, when we compare that to what the economy has been doing, you see what the problem is. The GDP back when Greenspan took over was $5 trillion. It's now $25 trillion. So the GDP is up 5 times. The Fed's balance sheet is up 45 times. Do you think that computes? Does that make sense? Can you have the money supply, fiat credit, tumbling into the system 9 times faster than the economy is growing over almost a third of a century, and not end up with some real, horrendous inflationary excesses? And that's what we have. We have inflation of financial assets. The stock market reached crazy heights. We have inflation of debt. You go back again to the same point when Greenspan took over, the debt of the United States. I'm not talking just about government now. This is everything, households, businesses, finance, and government, was 9 trillion. It's now 91 trillion. All right, so that's a tenfold increase. And the public debt during that period went from 2 trillion to 31 trillion, a 15-fold increase. So essentially, what's been going on is the economy has been pumped with so much cheap credit, so much easy flowing liquidity, that everything is out of kilter. Assets are way overvalued, debt is out of control, governments have no discipline left whatsoever. And the heart of the matter is in the Federal Reserve at the Eccles Building. That's where it all started. That's where it's all enabled. And now we're finally at the point where even the Fed lost control, and 35 weeks ago had to start backtracking with increasing speed. And that's why we're going to be in a totally new era that will not be nearly as much fun, I would say, as the party, which has been happening for the last 3.5 decades.
Yeah, well, it's funny, the lefties, the liberals, the socialists always claim, oh, wealth inequality is caused by capitalism. And of course, my response always is, I wish we had capital.
Yeah.
We don't have. Yeah. It's caused by socialism. That's what we have. So could you enlighten us with regard to the Cantillon effect and how the Fed's policies actually greatly increase wealth inequality?
Yeah, absolutely. And I think that I use Cantillon effect, sounds very mysterious and sort of like academic wonkish. But the way to look at it is that when the Fed pumps credit or liquidity into the market by buying bonds, and remember, until March, it was buying 120 billion of treasury paper and GSE government, mortgage agency paper a month after month after month. And when it does that, the theory is it's going to get out into the Main Street economy, and it's going to boost housing starts, and it's going to boost business investment, and it's going to trigger the consumer to spend more. But actually, most of all that money pumping, and especially since 2008, has never left the canyons of Wall Street. It impacted where it first landed. And I think that's kind of a simple way of describing the Cantillon effect. And as a result, it stayed in the canyons of Wall Street, and we got a huge inflationary wage in the price of financial assets. One measure of that is to look at where were we in December 2008 when we had the first big scare and crisis and the Lehman bankruptcy and meltdown and so forth. If we measure from that point forward to the recent peak, we find that the GDP is up 55% over that roughly 13-year period. But the NASDAQ 100, which is kind of the leading edge of the stock market, it's the tech sector, it's where the real speculative mania had its biggest impact. And I would say that's where all that credit first, impacted pricing. It's up 1,250%. In other words, the GDP up 55%, the stock market up 1,250%. Again, it doesn't compute. There is no way that the real value of stocks can be rising, 25 times almost faster than the GDP, which embodies the profits and the business activity that allegedly the stock market capitalizes. So again, the first wave of inflation, according to this theory, should have been in the financial system where it landed, and that's exactly what happened. But eventually, that liquidity, all of that fiat credit, worked its way through the financial system of not just the US, but of the entire planet, through the economies of the rest of the world. And we reached the point where it finally caught up with us on the goods and services front. That is to say, gas prices, grocery prices, commodity prices, and all the rest of it that goes into the CPI. So people were saying all these years, oh, you people that worry about sound money, you're wrong because the Fed is printing like crazy and there's no inflation. Well, there was. The inflation was in financial assets. It was right there in plain sight. And yet the Keynesians were able to, by definition, say, ignore the stock market, ignore asset prices, ignore housing inflation, which is up 300%, since the mid 1990s. Ignore all that and just look at not even the CPI, but the PCE deflator, and take food and energy out of it while you're at it, and look at what's left. And so that's how they lulled us into thinking there was no inflation. I never bought that. My book actually takes that apart and shows that even during the so-called lowflation period, there was actually a lot more inflation than people recognized, because what was happening, if you can believe this, is the effect of the Fed policy was to cause business activity, industrial activity especially, to be offshore. In other words, our costs were too high here. And then the Fed had this crazy 2% inflation. You got to have it because we'll be better off if the value of our money depreciates 2% a year. Anyways, crazy theory. But they kept pushing the price level up and up and up, which means that more and more work went to China or Vietnam or Mexico. And as a result of that, for a temporary period of time, as we were offshoring our manufacturing output and industrial activity, we were importing deflationary goods made in the cheap labor markets abroad. And so from 1995 to the 2019, when we kind of reached the end of the road, the price of durable goods dropped by 40%. If you could believe it. I mean, in this day and age where nothing goes down, right? I mean, people know from common sense and daily experience, almost nothing goes down. And yet during that period of time, the PCE deflator, the Fed's favorite, yardstick, the durable goods component of that dropped by 40%.
I'm sorry, is it a coincidence? Is it a coincidence that at the same time that Nixon was telling us that by taking away the redeemability of dollars with gold, that would ensure the stability of the value of the dollar? He also made a famous trip to China.
Yeah.
And that was happening at exactly around the same time.
1972.
Right. That's where the offshoring went. People realize when you make it impossible to pay a living wage because of the destruction of our currency, the corporations have no choice but offshore and enhance the employment of other countries at the expense of American workers.
Yeah, but here's the thing about where I was going with this. That's all absolutely true, but especially after mid-1990s, when the Chinese finally figured out that maybe rather than power coming from the barrel of a gun, as Mao said, that it might better come from the producing end of a printing press. And so they started running the printing press overtime. They built these big export factories. And so we did have 20% or 40% decline in durable goods index that the Fed swears by over that period, 1995 to 2019. On the other hand, domestically produced services increased by about 85% during the same period, the price of domestically produced services. So what we had was a split screen inflation that seemed to be measuring slightly under 2%. And so the Fed said, see, we're hitting our goals. In fact, we're running short. We got too little inflation. We got low inflation. But that was totally a mirage resulting from high domestic inflation and a one-time windfall of falling durable goods prices that obviously couldn't last forever. You can't have zero prices for all of that stuff that we're importing from China. And what has happened since 2019, and especially since the COVID disruptions of the supply chain that was offshored massively over that 35-year period or 30-year period, is we now have inflation in durable goods, non-durable goods, and services all at the same time. And instead of a reading that looks like it's under 2%, we got a reading of 7 or 8%. In fact, we had the producer price index year over year for October was over 11%. So we're in a totally different ballgame because the Fed was essentially lying about low inflation. Anybody could have looked at the components of the PCE deflator that they swear by. They could have looked at the components over that period and realized that we didn't have low inflation, that the money that they were pumping into the economy was, building up a head of steam that sooner or later would produce the kind of price explosion that we've had in the last year.
And at the same time, on the fiscal side, you had the stimmy checks.
Yeah. Oh, exactly. As a matter of fact, that's the one that really consternated me for a long time. I've been warning about the deficit ever since the 1980s, and they kept saying, well, look, they've run deficit after deficit. The public debt was $1 trillion when Ronald Reagan took office. It's 31 trillion today. So what? Well, the answer was that unlike the early 80s, still in the early 80s, when deficits were financed honestly in the bond market. And what I mean by that is if the Treasury was going to borrow $200 billion like we had in the early days of the Reagan administration, it was going to crowd out other borrowers who wanted money for mortgages or for car dealers to finance their floor plan, or small businesses to expand their factory, whatever the case might be. There was a crowding out effect as the Fed, as the Treasury muscled its way into the bond markets and drove interest rates higher and higher, and eventually caused private borrowers to drop away because rates were too high. At least when you had that kind of honest financing of the public debt, people could see immediately the untoward consequences. So, I was a congressman then, as you indicated, and I sure as heck heard from the farmers and the small businessmen and the car dealers and all the rest of them when the Treasury was borrowing like crazy and interest rates were at double-digit levels. Now, what happened, though, was the Fed discovered, Greenspan discovered that they could run the printing press with reckless abandon after 1987, and all of a sudden these big deficits were no longer financed honestly in the bond pits, but they were financed dishonestly at the Federal Reserve open market desk. They just bought the debt, and as a result, the balance sheet of the Fed, went from 200 billion, as I said, to 9 trillion. So that monetization of the debt, public debt, over that long period of time was one of the greatest acts of financial fraud in modern history, and it fooled, I guess you could say, fooled most of Washington into believing that they could get away with big deficits and that, well, maybe it's a problem in the long run, but we'll get to it when we can. Well, that's not true. And the Fed has now reached the point where it is no longer, and this is the key thing, It is no longer monetizing the debt. The QE is over, and it's actually in demonetization. That is QT. They're actually shrinking their balance sheet. They have to by 95 billion a month because they're trying to bring this, virulent inflation that we have to heal. So when they shrink their balance sheet and demonetize, they're pushing the financing of these big deficits, and we still have like 2 trillion annual rate of deficit right now at the federal level. They're pushing those deficits back into the bond pits, and that's why interest rates are doing what they are. Look, you could look at the 1-year note, 1-year Treasury note. That should be pretty straightforward. 1 year ago today, November 2021, the interest rate, if you can remember this, if you can believe this, people will be shocked. It was 15 basis points, 1/7 of 1%. Today, it's 4.8%, 480 basis points. That's how much just the 1 year has moved in the last 12 months as the Fed has belatedly figured out that it's got one hell of an inflation problem on its hands and it needs to reverse direction. So it's only beginning because as that works its way through the economy, people thought they were financing on 1 year at no cost are suddenly paying almost 5%. It's going to profoundly affect where the economy goes.
Rebut what a lot of Republicans say when they criticize your viewpoint. They say, well, Stockman is wrong because when you cut taxes, even if you don't cut spending, that increases the amount of taxes that are paid because the economy is revived, and therefore people make more money, have more capital gains, and the trickle-down effect works. How do you respond to that?
That's a good point. I believe in lower tax rates, all things being equal. But you can't just lower tax rates and expect that you're going to get 100% of the lost revenue back or even more. It just doesn't work mathematically because the federal tax rate averages about 20% of GDP. So you need to get $100 of GDP back for every 20 cents worth of taxes you cut in order to break even, right? I mean, you see the math, you get $100 GDP, you get $20 back, you cut $20, you're even. But that isn't necessarily what happens if we look at history. We get something back, and it's always better to have lower rates than higher rates, but you have to attend to the spending side as well. And the idea that you can have a free lunch, just cut taxes and it'll pay for itself, and you don't need fiscal discipline, no tough choices, you don't have to say no to any of the interest groups that line up at the trough in Washington. That was a very comforting delusion. It was called the Laffer curve back in the day. And it's unfortunately error that the Republican Party embraced because it was so politically palatable. They used to call me the root canal man because they thought I wanted to perform a root canal on the American electorate. Well, I didn't, but I wanted to be honest with the electorate and say, if we're going to have lower taxes, which is good for everybody and fair for everybody, then we're going to have to really find ways to reduce the size of government and the cost and fiscal burden of the spending machine. And that's the part they didn't want to hear about, but that's the part that you can't ignore.
Well, once you don't have character, you want to get things for free.
Right.
And once you get away from that quote unquote Judeo-Christian ethic, and most people with common sense means know that I'm not just talking about theology, I'm talking about an ethic, a character.
Right.
Where people know that they've got to work and sacrifice for the things they want to acquire. And they have to make their choices about how hard they want to work and how much they want to acquire. But today, we have people that want to take advantage And it's like when they say, oh, he's giving back, when
Yeah. Yeah.
money or something, he's giving. What do you mean he's giving back? He didn't steal it. The only time you need to give back is if you stole it.
Right.
And yet they act as if anyone who has acquired property or wealth has to give back to the community.
Well, I'll tell you what, I generally agree with you 100%. And on that point, I have a minor quibble. There is a certain kind of speculator in the world today who does believe in giving back, and we had a recent example of that in the last week. Sam Bankman-Fried. Okay, he stole money like there was no tomorrow, billions and billions from his customers, and he was giving it back to the Democratic friends who were treating him so nicely and patting him on the head in Washington. But if you, to be serious about it, if you need an illustration of how corrupt Washington has become, then look at this phenomena. This guy was the fair-haired boy of the Washington visitation circuit, and they were patting him on his head left and right. He gave something like $40 million to Democratic candidates just in this round. And you see what was going on. I mean, this was a house of cards like, we've never seen before. It made Madoff look like an honest man, I think, if you look at this. So I hope that people draw a big lesson from this, and not just that speculation eventually blows up in a spectacular fashion like FTX did, but that Washington is so eager for money, no questions asked as to where it came from and how it was generated, that they were willing to, treat this guy as the greatest thing, since I don't know what. But the point I think people should remember is just 2 months ago, I think September was 2 months ago. Yeah, right. The Fortune magazine cover in September had a picture of Sam Bankman-Fried, and the caption, which needs to just be printed over and over and over again, is this the next Warren Buffett? Okay. If the Main Street media, and Fortune once upon a time was a great financial magazine, it was, it was a source of, at least decent economic analysis information. If they couldn't tell as late as September 2022 that he was a fraud, then that's how bad off we are in terms of why the public dialogue is so far off base. If Fortune or Wall Street Journal, the rest of them, treat these people as legitimate, when there's no way that something like FTX could have been started in 2019. That's when it was started. That was a known fact. And this kid was 28 or 29 years old. That was a known fact. And they valued the last round, and this was big players like BlackRock and Sequoia and other California venture funds. They valued it at $32 billion in the last funding round within the last 12 months. And now it's obviously worth zero because it was never worth anything. Okay. And that's the kind of, mess that we're in, because we've lived in this bubble. That's why I call it the Great Money Bubble, because the Great Money Bubble is not only an economic problem, it is also it's a moral problem, in the sense that everything becomes corrupted when money becomes so crazy easy that people could follow a Pied Piper like Sam Bankman-Fried.
Well, Sam not only didn't give back, he gave people in the back.
Yeah, you're right.
With a knife.
Yeah, exactly.
So, David, I thank you for your time. Ladies and gentlemen, you have just listened to the antithesis of Sam Bankman-Fried. And go out and get the book, The Great Money Bubble, because you're not going to learn any of this in a school. Your kids, unfortunately, will not learn any of this in school. You've got to become autodidacts and self-educate. I'm a lawyer, folks, and believe me, they taught me nothing about the Constitution, nothing about anything. And if you're gonna just rely on school, you're done. You'll know absolutely nothing, and you'll be easily taken advantage of by the Federal Reserve and the politicians and all the Sam Blankman-Frieds. So valued David Stockman and his wisdom and knowledge, which is a rare commodity these days, and get the book, The Great Money Bubble. And sir, I thank you for your time.
Great to be with you. Wonderful conversation.
Thank you. God bless you and your family. Take care.
You too. You too.